Hi, and welcome back to the channel. We're putting out this quick video in response to a video that we did yesterday. It was about the banking crisis or potential banking crisis. And a lot of you had questions about unrealized losses at the banks. So this is just a small video to talk about that and to try and explain what unrealized losses are. The best way I can describe it is to think about the stock market. Let's say you bought $100 in stock and it's in your account. You bought one stock for $100. Then over time, the value of that stock dropped. Say the company had some losses and the value of the stock dropped to about $25. On paper, you have lost $75. You only have $25 worth of stock. And as a matter of fact, if you went to cash that in today, it would be $25. That's an unrealized loss. Until the day that you sell it, it's not a loss. It's just something that's on paper. And if the stock went back up to $200, and you sold it then, you'd actually have a gain. And that's really what the unrealized losses at the banks are today. The banks have long-term bonds that they invest in and short-term securities that they invest in. And basically, when the value of their portfolio drops below the market value, that becomes a loss for them. The value of a bond is determined by the interest rate of the bond, and it's relative to how the interest rate is on the open market. So what does that mean? Let's say you bought a 5% bond for $100. If the interest rate on the market goes to 6, 7, or 8%, your bond is not going to be worth $100 anymore. It's going to drop considerably. If the interest rate goes down to 2%, then your bond becomes more valuable because it's paying a higher interest rate, and the value of it will actually go up. So what's happened with the banks is that they've purchased bonds as part of their asset class, and those bonds are at low interest rates. And as interest rates rise, the value of their bonds drops dramatically. And that's called an unrealized loss. That's what all the news reporting is about these days. These are unrealized losses at the bank where they've invested in something and the value of that thing they invested in, which in this case is a bond, has dropped in value. It's called an unrealized loss because they haven't sold it yet. Think about it this way. They have a $100 thing. The value is dropped to $50, but until they sell it, they don't have to report it. It's an unrealized loss. And what that means is that if they hold it long enough and the value of it goes up, then they never had to claim that loss, and in fact, they can say they made a gain on it. That's the long-term play for a bank. They don't want to show these losses and write them off in the year that they're a loss. So what does that mean for you and me? You think the bank has $10 million in assets sitting there, and you can just withdraw as much money as you'd like. But in reality, they don't have $10 million of assets that they'd have to cash to get your money for you. They've taken a loss on that, and if you were forcing them to write those losses off today, they might only have $5 million worth of assets. So you can see in a scenario where you have unrealized losses at a bank, if everyone starts to withdraw their funds from the bank won't have the money to give them because they've taken losses on bonds that they will have to liquidate to give you your money. So it's a real mess of a situation. It's not super critical. The Fed is watching this, and there's a lot of safeguards for it. However, if you combine that with the fact that there's been a big run on the banks lately. Bank of America, JP Morgan Chase, Wells Fargo, Truist, all these companies are reporting massive outflows of cash from their bank. And so now you can see that you need to worry. Are they going to have enough cash, and do they have the assets in place to cover you when you go to take your money out? Remember, under $250,000 is guaranteed by the FDIC. So most of this won't affect you, but it could close your bank for a few days if there's a run on it, or there's going to be more of a consolidation of the banks, as larger banks or banks with more assets have to buy up the smaller banks or the banks that have the worst balance sheets. So that's it. When you combine that with the little hiccup we had in the ACH system over the weekend, people were having deposits put in a bank, but they couldn't get access to it. It starts to make you feel a little queasy. And that's why we put out the video. If you have any questions, please feel free to leave comments below. We will try and answer as many as we can. Don't forget to like and subscribe to the channel. It really helps us out, and we're trying to grow it and provide you with the information that you need. Have a great day, and as always, happy investing.